Here's a question. How do you buy a $100 million company when you only have $10 million? You borrow the other $90 million, and then you make the company pay it back. Sounds crazy, right? But this is exactly how some of the biggest business deals in the world actually work. It's called a leveraged buyout, or LBO for short, is when someone buys a company using mostly borrowed money. Now, I know that sounds insane at first, but stick with me because the logic actually makes perfect sense. Think of it like buying a rental property. You want to buy a house for $500,000. You don't have $500,000 sitting around, so you put down $100,000 of your own money and borrow $400,000 from the bank. Now, here's the key part. The rent from your tenants pays the monthly mortgage. Eventually, years down the line, the mortgage is paid off and you own a $500,000 house, even though you only put in $100,000 yourself. An LBO works exactly the same way, except instead of a house, it's a company. And instead of rent from tenants, it's the company's profits that pay back the loan. And a few years later, you sell the company for more than you paid. The key thing to understand here is that you're not paying back the loan with your money. The company pays it back with its money. That's the leverage part. You're using borrowed money to control an asset much bigger than what you actually have. Now, I know what you're thinking. Okay, that sounds good in theory, but how does this actually work in practice? Let me walk you through. Imagine there's a software company called XYZ. It makes $10 million in profit every year. It's stable, it's profitable, it's honestly kind of boring, which weirdly enough is exactly what you want for this kind of deal. The current owner wants to retire and is selling the company for $80 million. So here's what happens. You, the buyer, put up $20 million. Now that might be your own money, or more likely it's money from investors who trust you to make this work. Then you go to the banks and borrow $60 million. And you might be wondering, why would the banks lend me that much? Well, they say yes because XYZ's assets, its customer contracts, its technology, its office building, all of that serves as collateral. If things go south, the bank can seize those assets. So now you own an $80 million company, but your actual cash investment was only $20 million. Already you can see the leverage at work. But here's where it gets interesting. XYZ continues operating just like it did before. It still makes $10 million in profit every year. But now where does that $10 million go? Most of it goes toward paying down that $60 million loan you just took out. Some of it goes to interest on the debt, and a small portion gets reinvested back into the business to keep it running smoothly. This happens year after year. The company is essentially paying for its own purchase. You're not reaching into your pocket every month to make loan payments. The business is doing that for you. Now, while the debt is being paid down, you're not just sitting around doing nothing. You're actively working to make the company more valuable. Maybe you cut unnecessary expenses. Let's say there's a $2 million office lease that can be renegotiated for half the price. Maybe you improve operations by automating some manual processes, making the whole thing more efficient, or maybe you grow revenue by expanding to new markets or launching new products. Let's say through all these improvements, XYZ is now making $14 million a year instead of $10 million. That's a 40% increase in profit. So fast forward 5 years, you decide it's time to sell. Here's where you are. The company now makes $14 million in profit instead of $10 million. Over those 5 years, you've paid off $40 million of the original $60 million loan, and you sell the company for $112 million because remember, it's more profitable now than when you bought it. Let's do the math. Sale price is $112 million. You still owe $20 million to the bank to clear the remaining debt. That leaves you with $92 million. Your original investment was $20 million. You walk away with $92 million. That's a $72 million profit in 5 years. That's a 4.6 times return on your money. And here's the crazy part. Most of that value was created by the company itself, not by you pouring more cash into it. That right there is the power of a leveraged buyout. But let's dig a little deeper into where that profit actually comes from, because it's not just magic. There are really 3 main ways you make money in an LBO. The first one is debt paydown, and this is honestly the most straightforward. When you buy the company, you owe $60 million to the bank. Every year, the company's profits chip away at that debt. After 5 years, maybe you've paid off $40 million, so now you only owe $20 million. When you sell the company, that $40 million you've paid off, that goes straight into your pocket instead of the bank's. You didn't add a single dollar of your own money after the initial investment. The company's cash flow did all the heavy lifting. The second way you make money is through something called EBITDA growth. Now, EBITDA is one of those finance acronyms that sounds scarier than it is. It stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's the company's operating profit, the money it makes from actually running the business. When you buy a company, you You look for ways to increase this number. You might cut costs, fire redundant positions, renegotiate contracts with suppliers, move to a cheaper office. You might increase prices. If customers love the product, a small 5 or 10% price increase often goes completely unnoticed. Or you might grow sales by expanding into new cities, launching complementary products, or even acquiring smaller competitors and folding them into your company. If you can grow EBITDA from $10 million to $14 million, like in our example, the company becomes worth more when you sell it. Why? Because buyers pay a multiple of profit. If someone's willing to pay 8 times profit, they're paying $80 million for a company making $10 million. But they'll pay $112 million for a company making $14 million. Same multiple, bigger profit, bigger price tag. Now, the third way you make money is the trickiest one, and honestly, it's the hardest to control. It's called multiple expansion. Here's how it works when you transform the business model, like turning a one-time product into a subscription service. Sometimes it's when you scale the company up because bigger, more established companies get higher multiples. And sometimes it's just market conditions. If you buy during a recession when everyone's scared and sell during a boom when everyone's optimistic. But here's the thing, and this is important. You can't always count on multiple expansion. The smart investors focus on the first two things, paying down debt and growing profit, because those are actually within your control. Multiple expansion, that's often just luck and timing. Nice when it happens, but you don't build your whole strategy around it. So at this point, you might be wondering, okay, who actually does these kinds of deals? The main players are private equity firms. These are investment companies like Blackstone, KKR, Apollo. Maybe you've heard of them. They raise money from wealthy individuals, pension funds, university endowments, and then use that money plus a whole lot of debt to buy companies. You also have family offices. These are basically the wealth management firms for ultra-rich families. Sometimes they'll buy companies using the LBO structure to grow the family's wealth. And every once in a while, you have individual investors, maybe a successful entrepreneur or a former executive who knows an industry really well. They'll buy a company using this same playbook, especially for smaller businesses. Now, why do they do this? Why go through all this trouble? Simple. The returns are massive compared to other investments. The stock market averages somewhere between 8 and 10% per year over the long term. Real estate might give you 12 to 15% if you're doing really well, but a successful LBO, that can return 20 to 30% per year, sometimes even higher. Plus, you're using leverage to amplify those returns. You're controlling a $100 million company with only $20 million of actual money. That's the beauty of it. But even if you're not buying companies, and let's be real, most people watching this probably aren't about to go buy a $100 million software company tomorrow. Understanding how LBOs work teaches you some really valuable principles. It teaches you how to use debt strategically instead of just fearing it. It teaches you to think in terms of cash flow and value creation, not just top-line revenue. And it shows you how businesses are actually bought, sold, and valued in the real world, which is super different from what most people imagine. And who knows, maybe one day you'll buy a smaller business using these exact same principles. It doesn't have to be $100 million. It could be a $500,000 laundromat or a $2 million software company. The mechanics are exactly the same, just with smaller numbers. Now, I don't want to paint this as some perfect risk-free strategy, because it's definitely not. There are real risks here that can blow up the whole deal. The biggest risk is pretty simple. What if the company stops making money? If revenue drops, maybe because of a recession or new competition pops up or management just screws up, the company might not generate enough cash to pay the loan. And when that happens, the bank steps in and takes the company. You lose your entire $20 million investment. Game over. Another risk is overpaying. If you pay too high a price up front, even if everything else goes perfectly, you might not make a good return when you eventually sell. This is why valuation is so critical. Paying 12 times EBITDA for a slow-growing company in a dying industry, that's usually a terrible idea. Then there's interest rate risk. If you borrowed at a variable interest rate and rates suddenly spike, which by the way has happened a lot recently, your debt payments can skyrocket. That eats into your cash flow and can turn a profitable deal into a nightmare. And finally, there's exit risk. After 5 years, you're ready to sell and cash out. But what if no one wants to buy? Maybe the market is terrible at that moment. Maybe the industry is dying and no one wants to touch it. You're stuck. Your investors are calling you asking for their money back. The pressure builds. It's not a fun situation. So the bottom line is this: LBOs are high risk, high reward. When they work, they create generational wealth. When they fail, people lose everything. That's why the best LBO investors are incredibly careful about which companies they buy and how much debt they take on. They're not just gambling, they're calculating every move. If you take away anything from this video, I want it to be these core principles. First, cash flow is everything. You can only do an LBO on a company that generates steady, predictable cash. No cash flow means no way to pay the debt, which means disaster. It's that simple. Second, debt amplifies outcomes. Good decisions get magnified, bad decisions get magnified. Leverage is a tool, and like any tool, it makes everything bigger, the good and the bad. Third, you make money on the buy and the sell. Overpaying kills your returns before you even start. Selling at the wrong time kills your returns at the end. Both matter equally. And fourth, operations matter more than finance. You can do all the fancy financial engineering you want, but the real money is made by actually improving the business, cutting costs, growing revenue, making it run better. That's where the magic happens. So that's a leveraged buyout. You buy a company using mostly borrowed money. The company pays back the loan with its own profits. You improve the business over 3 to 7 years. You sell it for more than you paid. You pocket the difference. It's not magic. It's not luck. It's a system that's been used for decades to create enormous wealth. And while most people will never do a $100 million LBO, the principles apply everywhere. Using debt strategically to buy assets, focusing on cash flow, not just revenue, improving what you own to increase its value, having a clear exit plan, whether you're buying a company, a rental property, or even just managing your own career, these ideas matter. You came here wondering what a leveraged buyout was. Now you know exactly how it works, how people make money from it, and why it's one of the most powerful wealth-building tools in finance. If this made sense to you, hit that like button. Subscribe for more finance concepts explained simply, and drop a comment. What's one business you'd love to buy if you had the chance? Thanks for watching. Let's keep learning together.